Good afternoon. This is Greg Lopez from Oswald Companies here with Jim Paliff, and today we're going to discuss succession planning for business owners in general, but a little bit more specifics as it relates to the transportation industry. So we'll be going over some of the items that are pertinent to single owners, partnerships, or family businesses that want to keep the business within the family. So the first question really to ask yourself or potentially the people that you are working for, if you're in the capacity of an advisor, is really what simply does the owner want to have happen to the business? Does the transfer mean that he wants to sell it to employees? Does the transfer mean that she wants to have an exit with a cash component where they're completely out? Do they care about the employees' jobs after the fact? There's a lot of considerations that go into the conversation. There's really two types of planned sales. I should say there's a planned sale and an unplanned sale. Planned is simply doing the work ahead of time and figuring out if you're actually going to sell and go down the road of selling that business, potentially handing it down to the kids, even doing a private equity infusion where you're going to take on private equity and essentially work for somebody to grow that business larger than you could have potentially grown it. Anything else is unplanned, really. Death and disability, since we're in the insurance industry, is what we take a look at a lot. If you're not planning, these are the things that will take you out in a way that will force a sale. So we'll discuss a few of these as well as the planned pieces. The first steps typically are going to be involving your attorney and your CPA as early as possible. One of the things to consider is don't hesitate to ask for a non-disclosure statement from some of the individuals that you're disclosing that you might be on the market for. Very often in the industry, you're going to see people that really don't have an incentive to keep their mouths shut. They will talk about your business, even though you think they will not. The non-disclosure statement tends to put a tight seal on the fact that you may be up for sale. You may not want employees to know, you may not want your competitors to know, so something to consider. The other piece is an actual buy-sell agreement. When you're actually looking to exit a business, you want to consider whether or not you have a legal document that simply states, if you have a partner specifically, what happens if that partner wants out of the business, if they become disabled, or if they die before you actually sell the business. So that legal document is quite important to put in place as early as possible. The other component is do you go and market this to yourself, or do you take a look at a business banker potentially to market it for you? Very often we find that owners of businesses in trucking or not in trucking will say to us, well, we know that our buyer is X, Y, and Z company, and they said they have interest, so they'll be the ones to buy us. And sometimes they're right, and sometimes we'll find a much better deal when they engage a business banker to shop the market for them. Not in every case, but something to consider. The other consideration is that valuations in general in the economy are high. People are still flush with cash who are looking to buy businesses. Interest rates are still very low, so the cost of acquiring a business is still affordable. Historically, even as rates have risen recently, we're seeing still cheap money historically. So when you sell is a consideration, if that's on the docket. So taking a look at what current valuations are. Some individuals want to keep the business in the family and want to pass it down to the kids. That sometimes works out, sometimes doesn't. Are the kids capable is a question? Do they even want to run the business? A lot of kids these days are enticed by more technological operations or things that might seem more interesting to them. So something that's important to talk about with your kids when the time is right, if that's one of your plans. One of the biggest issues is if you are going to pass it to your kids, how do you structure it? They obviously don't have a large sum of cash to buy you out so that you can retire. So that gets very tricky, how you're going to reap the benefit of the business that you've built while passing it down to the next generation. Also, we discussed just quickly private equity. If you've been running your business or your clients have been running their business, do they want to infuse private equity and work for somebody else? Resoundingly, that answer is no. So that could be a consideration before you think of going down that road. If you don't plan the sale will plan you. If you pass away before the business is actually sold, the question is it worth less? And a lot of times in your industry, we find that the relationships that the owners have are a main driver in sales. So if you're not around, what is stopping your clients from going to another company? Usually not much. So how do you make sure that your spouse, if you have one, is provided for in the event that you pass away early and your business becomes worth less? The other one, which is more likely, is disability. What effect would disability have on your business? If you can't physically get to the office or speak to clients or travel, will that affect your business? A question to think about. And then what will the company's value be if that were to happen? The other consideration is if you were to pass, is there going to be a transfer tax? In the state of Ohio, there's not a state tax for passing the assets down to the next generation, but there can be an estate tax or a death tax if your company is large enough. So there's a few different ways to take a look at the continuation planning. These are the majority of them. You have partnerships, entities that buy out individuals, key people, and we'll touch on disability. So to hit it home on a partnership situation, if this suits you, we'll take a look at a case study here. And this is what was called a cross-purchase agreement. And all that means is that there's at least more than one individual that owns the company, and they are going to agree to sell the company to the other upon death. So there's an issue with this one. Let's say that this business has $30 million of value. So they have put in place life insurance policies and an agreement as well that states the owner will buy out the other with the proceeds of the policy. Well, the problem is in this example, you have a $30 million business and only a total of $10 million of insurance. So let's take a look at what happens. And pardon the cheesiness of a couple of these photos here. If you were to pass away, and this is your wife, and there's only $5 million of coverage, it's not enough money to fully buy her out. So whether you like it or not, this will be your new business partner who can show up, not show up, participate, or potentially inhibit your growth of your business. There's nothing you can do about it. There's no way to facilitate that buyout with the insurance in place. So that becomes a problem. So what's the solution? The solution here is to update the insurance policies to a $15 million policy per person. So this typically we see this when a business is young and there's maybe $1 or $2 million of insurance, but now the business has grown by multiples and there's a lack of insurance or they're underinsured, which can't facilitate a proper buyout. So we simply place an additional $10 million or a total of $15 million per. Now the spouse of the decedent receives the proceeds, and the business then goes to the owners, giving them 100% control and ownership over the business. If there are more than two owners, we tend to see that there is what's called an entity purchase. And the reason is the following. If the individual has to have a policy on every other individual, so each person basically has 3 policies, which translates to 12 separate life insurance policies with different ownership, different payers, and that can get kind of messy. So what we typically see here is the company being the beneficiary of all 4 life insurance policies. And if one of the owners were to pass, the policy goes to the company, and the company then pays out that spouse of the deceased partner, and the remaining shares of that deceased partner are spread evenly among the other partners. And this is what's referred to as a entity purchase. And one of the drawbacks to this is that there's not a step up in basis for that decedent's estate. So what happens is there may potentially be greater amount of tax owed and a greater capital gain paid here, as opposed to a cross purchase, which we looked at over here. Cross purchase ensures that the step up in basis occurs at death because the owner of the insurance policy is the other partner, as opposed to the entity. So a couple of considerations, very important when you're looking at these. There's also a situation where you may have a partner that has a sibling a key employee, or in this case, even a child that wants to own the company, and it's simply a one-way buyout. So this is an example of an individual to the left who owns 100% of the company, and the individual on the right owns none of the company. So think of this as your newly out of college child who cannot afford to buy you out, but purchases a life insurance policy on dad so that mom, in this example, would have the proceeds of the policy and son would then retain the business assets. So let's take a look how that works. Simply the estate now owns the value of the company, and now the individual, the son, the daughter, or the key employee now owns 100% of the company. Well, let's take a look again, since I mentioned a key person, why we see a lot of our clients placing key person golden handcuffs, if you will, on them. I'll give you an anecdotal example here. We have some industries that are getting more and more reliant on technology, so they have younger people coming on who are changing the way that they're operating, and they're really integral to the role and to that business, and they're responsible for the growth of that business. Other times we see someone that is taking over operations, or simply an owner of a business that wants to stay around long and be able to move away from the business and not be the key responsibility for driving growth. So there's people that are very key to that operation. And a lot of times we'll see them place a benefit, an executive benefit, if you will, and this one happens to be in the form of insurance, on that individual. So there will be, over the years, cash that grows inside this policy. And let's assume that we have $12,000 that's going as a contribution to this relatively younger individual who's key to the business. Over a period of time, they're going to give access to that cash, but maybe not until after year 5. So year 1, even though there's cash value of $10,000, in year 2 there's $23,000. For the key person, there'll be zero value. So if they were to leave that company, they're giving up after year 5, a $64,000 benefit and a $450,000 death benefit for them and their family. So it's a golden handcuff of sort to keep that in play for themselves and for the company. Now, if that individual were to pass early or were to not die but to leave the company, the owner would retain the value of the cash, and they would retain the death benefit. If they surrendered it, they would obviously just have the cash. And if they died early, it would provide $450,000 to retain another employee that they may have to take from a competitor or may have to shop or bring them in for another market that has the expertise that they're looking for. So it provides a value for that individual, for the owner, to attract new talent. And typically we see these agreements where the owner of the company would kick back some death benefit in an agreement back to the family if that person were to die early. Disability. It is the most overlooked part of a contingency plan, which is ironic because it is actually it's more likely to happen than death. Disability is a greater likelihood than death, and it's often overlooked. It should be part of a buy-sell plan. The simple thing to ask yourself is, what happens if an owner can no longer, and put yourself in the shoes of that owner, if their partner could no longer show up, participate, speak to clients, is it fair that that individual has to show up? Is it fair that person gets 50% of the revenue? Usually not, and provisions are made in the form of a buy-sell agreement to provide for that. Typically, people view disability or are familiar with disability in the form of a monthly or annual premium, and if disability occurred, a monthly benefit to that individual. There are lump sum policies that will pay $1 million, $2 million, up to $10 million in many cases of disability lump sum, so that if a partner became permanently disabled, that partner would have the proceeds to be bought out, and the shares would then go to the individuals who own the remainder of the business. Those type of policies are through Lloyd's of London typically. There's other specialty insurers, but Lloyd's tends to be the number one provider of those. So just to recap this portion here, what really is the major problem in each scenario? It's liquidity. The lack of liquidity and the lack of the ability of the owners really to put away large sinking funds to provide for a buyout is replaced by the use of life insurance. It's used because it's affordable. It transfers the risk to an insurance carrier to fund a proper buyout or disposition of a business if you were to die before seeing that disposition through. So it's highly effective, highly affordable. There's a few ways that you can place insurance if you're looking for that. There's also some drawbacks to insurance. We won't avoid those. We'll talk about those as well. But typically people look at insurance as term and whole life. Whole life is sort of the way of saying Kleenex. It's whole life describes about 6 or 7 different types of permanent insurance, and we'll talk about a few of these to educate you on them. Term is very simple. You pay life insurance premium for, let's say, 10 years. After 10 years, it goes away. The purpose is usually to pay off a specific debt. A lot of banks will actually force you to have a life insurance on file so that they can have guaranteed payment upon death of any loan proceeds that are outstanding. It's always pretty affordable unless you're uninsurable or older. We'll discuss some ways around that. If you have a business sale imminent, I have a client currently who knows that they're going to sell in the next 5 years. So we bought the shortest duration policy possible. It's a 10-year policy. He may cancel it in 6 months. He may cancel it in 2 years. Whenever that sale is through, they no longer have a need for that policy. Other certain expenses, and a lot of people buy term insurance if they're just uninformed about other forms. It doesn't make it wrong or right if they own term. It's just that's what they know. Permanent insurance, again, is a broad brush and paints a broad picture over anything that is basically not term insurance. So there's some key features to permanent insurance. Typically, you have cash value growth inside. So it's a component of the policy by which if you were to cancel it, after a certain number of years, you would have cash that you could take out, sometimes in a tax-free manner. So you're not 100% of the expense is not gone because you're made whole by some of that cash. The reason you would have permanent is if the liability is stretched beyond a specific term period. If you didn't know if you're going to sell your business or if you're passing it down to the next generation, that would be an ideal or necessary reason to have permanent insurance. Some people have a desire to just simply have paid-up insurance. I'll give you an example towards the end here. If your business is multi-generational, you almost always need it because you don't know how long you're going to stay at the helm or if the next generation can buy you out. Sometimes, if you're old enough or your health is in a certain circumstance, it may be actually less expensive than term insurance, and you get the benefit of keeping it long-term. A lot of people like it because there's a guaranteed death benefit that's paid out. As long as you pay a premium, the death benefit will be paid out in most cases. Some people will use it for estate planning. You can't use term insurance for estate planning. It doesn't work. It usually won't last as long as you do, so you'll outlive the coverage and your planning will be for naught. People use it for charitable planning. One of the things we see a lot is our clients have possibly a second marriage and they have an age gap. So their term insurance might be fine for their age. Maybe it lasts them to age 70 or 80, but their spouse is maybe 15, 20 years younger in some cases. So it doesn't provide much coverage for them. Therefore, they'll have to buy permanent insurance to provide for their spouse longer term. And very often we see owners that have a business, they pass it down to their kids, but maybe there's 2 kids and only one of them is capable and willing to run the business. And the other they don't want to write out of their will, but they're not exactly cash rich. So what we'll see sometimes is a slice of insurance that's left for one of the children that is not participating in the business, so that when the spouse and the client are gone, at least some value is left for both kids to equalize the estate to some degree. Typically what we see right now in the market is indexed universal life. The reason it's attractive at the moment is it's flexible to fund. If you can't pay it in a particular year, you can make it up the following year. The death benefit can increase, so it can grow with you as your business grows. You can take loans out of it. Those loans can be very valuable because they're tax-free in a lot of cases. We see a lot of people who try to max out other forms of cash assets. They may be taxable, they may be qualified. If you're looking at an IRA or something that is tax deferred, you typically can't use those in your business operations as collateral. Life insurance cash value can be a collateral asset to use to grow your business. They're also beneficial because you have a growth component in all life insurance that's not term. There's some sort of growth component, and these participate in the S&P typically, with the safe downside knowing that you cannot lose money inside the accounts. Usually the floor is a 0% floor, or sometimes it's up to a positive 2% floor. But I'll show you an example that right after here that shows in a worst case scenario in a 2007 or 8 in a recession, even if the market were to collapse 30 or 40%, you would not lose anything inside the cash value of your policy. So people like that portion of it. The give up to that is on the upside, you give up some of the upside. The caps in these range from somewhere around 9 to 13%. So that means if the market goes up greater than that, you don't participate in anything above 13%. So as an example here, and I hope you can see this, if you look in 2013 and just look at a cap of 13.5%, the market did 29.6%. That's great, but you only earned 13.5, which is the cap of the index. So this is the cash value of your life insurance policy. It's going to grow by 13.5%. In 2012, it did 13.41, just a hair below the cap. You're going to only earn the 13.41. But look at the following. Let's look at 2008, where it was down 38%. You lose 0. So the pros are the floor of the account not losing any value. And the con could potentially be that you're not participating in the full growth of the market. So here's an example of a client who needs some permanent coverage. And this is an example of someone, let's say they don't want to add greater amounts of 401k benefits. Maybe the demographics don't work well. Pension's not going to work for them. So they're going to use the cash value life insurance as an asset to create for themselves a benefit, and just for themselves. They can be discretionary. If there's an owner that makes a high salary and he did any other type of qualified plan, he'd have to allow the others to participate in it in some degree. Not in life insurance. You can be completely discretionary. So in this example here, let's say we picked a 10-year time horizon where we knew we were going to fund a policy with an overfunded amount of $50,000. That buys us a death benefit of a little over $1 million. Now this is designed to have a low death benefit and a high amount of cash. So you see in the 10th year, you have about $500,000, $585,000, and you've put in a significant amount. Things don't always work as planned. So let's take a look at the flexibility of this type of insurance and say, okay, we had a few good years. We got up to year 5. Now in year 5, we can no longer use this policy because profits are lower, our margins are shrinking, whatever the case is. So I just want to hit home the fact that you haven't made a mistake yet. Because it's flexible, what you would do is simply stop paying your premium. Your death benefit would not grow as aggressively, and neither would your cash value. So your cash value is going to be stifled. It's going to be smaller, but it's still, the value of the assets you put in there. It's $244,000, and it does increase as well over time. But let's just say you plan on a 10-year plan to put a policy in place that was fully funded, but only 3 years out, you decided that it was no longer feasible to continue the plan. Well, still not a bad decision. Your cash value growth is obviously not going to grow as high. Your death benefit is not going to grow as high, but you'll have coverage that may last you for life expectancy. In this example, it's going out to age 95. So it is a flexible plan. You're not committed necessarily every single year to fund the full amount, and every year is a reassessment of where you need to be. And to talk about this a little bit further and why someone would put cash into a plan that has a lower possible death benefit, is almost the same explanation. Here, this individual is going to put money in for, let's say, by the way, it's a 45-year-old male as an example. Put in money for 20 years, and the reason they're putting money in is because it's excess cash they want tax deferred, so they're going to gain the tax deferral. They need the death benefit for personal reasons and business reasons, so they have a death benefit. They like the fact that the cash value will grow and cannot go down. So that's another component. But one of the biggest drivers for this particular policy is as long as they leave a death benefit behind, this individual will always have a tax-free distribution of income. So in this example here, you'll see the $50,000 going in for 20 years. And in the 21st year, they're going to start taking their money out. So they put in a total of $1 million over their career. Now they're going to take out $163,000 for, let's say another 20 years. So two things happen. They still have a death benefit for their family. They're getting tax-free distributions. So you'd have to calculate your own tax rate, but what is the taxable equivalent of having to pay tax on, let's say, a bond that kicks off $163,000? What would you net out of that? It's much less. Maybe you're in the 30% tax bracket. So that could be as high as $200,000+ of a taxable equivalent income stream for an individual. So the numbers at the bottom tally here. Tally here, $1 million in and about $3.2 million out, which is tax-free, all the while keeping some death benefit for business and personal needs. So we talked briefly about the affordability of term insurance. A lot of our clients tend to look at preserving their estates, doing business planning later in life, which means their medical history has caught up to them. There's more doctor's records. There's more doctors. There's more issues in a lot of cases. In addition to that, their ages are older. So just by nature, they're going to be more expensive. So this is an example of someone, I wanted to show you an example of someone not necessarily paying the premium that they could afford, but just paying interest on the actual life insurance policy itself. So we'll get into some details. I don't want to overwhelm you, but essentially here's what happens. An individual who can afford a large premium for a large death benefit would go to a bank and simply borrow the premium for the bank. The bank pays the premium for them. There's some collateral that's assigned, and that could just simply be cash or assets that are in another brokerage account or any liquid account. The bank is then going to pay the premium, and the owner is responsible for paying the interest on the loan, and then some collateral. Now that collateral will go away, which I'll show you. And then the loan has a life where it's paid off at some point in time. That loan doesn't stay out there forever. It's designed to be paid off either at death or at a certain point where you have cash value available. Now, this is a lot of stuff, but I want you to concentrate just on a couple of things here. This is the death benefit. So I described earlier that death benefits are designed to increase over time. So in the indexed universal life. So we're starting out with about a $15 million death benefit, actually almost $16 million death benefit, and it increases. So at life expectancy for this individual, which might be out, let's say 35 years, you end up with a $26 million death benefit and start with a 15 just to start. So here's the actual death benefit. If the individual were to, pay a premium and pay it over 7 years, if you look at column 2, it says annual insurance outlay. They would have to pay $760,000 to pay for this death benefit. That's a lot of cash flow. The reason it's so high is this individual is a smoker, they're older, and they have a driving record that's not ideal. So this is an example of an hard to insure or an expensive to insure individual. So again, death benefit over here, but this is what they're going to pay. They're going to finance the policy and pay the interest only, $85,000. Over time, you'll notice that this in red here in column 12, the collateral goes away. It starts out at about $500,000, creeps up, and then goes back down. The reason it goes down is the cash value of this policy then becomes the collateral. There's no more need for collateral. So if I'm looking at this, my question is, how do I get out of it? In this example here, you have cash value, a surrender value. So the cash value net of the loan is really what the exit is for this individual. So after year 12, they're fairly free to exit this policy and be made whole, and it would work for them. Now, one of the factors and variables that you have to take a look at are the interest rates. So what are the borrowing rates for this individual? So if rates skyrocket, we might have to put more cash into this than we thought. If rates decrease, we may be able to put less inside of here. And the other component is if the growth of the account, which we have here at 6.21 in the upper right-hand corner, which we think is pretty modest. If that is higher than that historically, then we can put less cash in. If it's lower, then we'll have to put more. But to hit home why someone would look at this, potentially an older client or someone who has a large death benefit need, who can afford a large premium but chooses not to pay a large premium. They're going to pay the interest and take some of that risk on the interest rate side. So another example that I wanted to show you is an individual who might need insurance but doesn't really know. Right now, no one knows what's happening in the economy, I should say in the political market. Tax rates have been lowered. Estate tax exclusions have been raised to nearly over $20 million, which were only half of that a couple years ago. So a lot of clients who needed to engage in estate planning don't know if they need to engage in it. If they died tomorrow, they don't. But they don't know what the estate planning environment is going to look like in the future. So who might be appropriate for this? And I'll show you the design shortly. This is someone who doesn't really know if they have the need for the insurance or even the liquidity. But it provides an option for insurance, which I'll explain, and provides a low upfront cost. So kind of complex, but this is simply a continuation of a long spreadsheet. It goes from an individual who's 48 and 49, so a married couple, and they need $6 million of death benefit. What they're going to do is pay one time in year one, $147,000, represented in the thing that says annual premium. That's the column. They're then not going to pay premium for another 31 years. So that is a long time to be able to essentially have an option to continue the insurance coverage. By that, I mean a relatively small upfront premium compared to what the premium would be on an ongoing basis. They will pick it up back at age 79 and 80, and that premium will be slightly higher than if they were to be paying an annualized premium. But really, it's someone who has a placeholder for a $6 million death benefit that in the future can continue if they need it. If not, they can cancel it, and they would, have insurance coverage out to age 80 essentially. Then it would go away if they never paid a premium. However, if you look, there's a few numbers or a few columns here, rows I should say, from age 66 to 73, where the cash value is estimated to be higher than what they actually put in. So this is your out. This is the scenario where you've put it in place and you no longer need it. Well, if you simply wait till age 66, you have 20 years of coverage of $6 million and then can get your cash back out of it. This is assuming it runs somewhere around 5% growth, so not egregiously high, but is really appropriate for a couple or an individual who doesn't want to pay an ongoing large maintenance for the insurance premium, but can afford to wait maybe 20 years out and have that initial premium locked up. And then if you look out in age 81 and 80, it is a larger premium and it does increase. However, if you have an estate tax, that means you have a pretty significant net worth at this point. You have a need for the insurance. Maybe there's a business you're passing to the next generation. So it's assumed if you really truly needed it, there would be plenty of cash flow in business operations and other assets to continue a policy like this. It's a very high internal rate of return at life expectancy, which is highlighted in yellow. It's almost 8% on a guaranteed basis of an internal rate of return. So pretty attractive for the right person. Let's just take a look at the other side. And again, pardon the cheesy graphics here. The other side of the equation, which is the family. We do allow the planning so that the business can continue, but what really happens to a husband and wife as they are looking to solidify their planning? So let's look at a situation. Dan and Sue. Dan is really the business owner. Sue has raised the kids as a primary responsibility. Maybe she's done some of the books in the office, but in no way, shape, or form does she want to run the business, or is she capable with the skill set to run the business. So Dan's going to provide for her in the case of his death. So they're both age 50. They have a $20 million business, hypothetically, on paper. He's the sole owner. They don't have a lot of cash on hand, $150,000 for a $20 million business. And you might think that's low, but typically we don't see our business owners as being cash rich. Most of it's going back into the business to grow the value of the business, which is their largest asset. He does want to leave it to the kids. He says that he has insurance and he's all set, which we hear all the time. But is this the whole picture? And a lot of times in reality, it's not. Lack of communication leads to a lot of theories or thoughts that aren't always true. So, the skill set to run the business, Sue probably doesn't have it and has no desire to have it at this age. Dan has $2 million of coverage, which he told us, and he was right, and he has coverage, but he bought it we bought it when it was 38, so he only has 8 years of coverage left in the policy. Kids don't really want to be in the business. We talked about this earlier. You have a lot of situations where the intent is to pass it down, but if something happens to our infographic Dan here, the kids really wouldn't have interest, so their business would probably falter, or they would probably push it up for sale. And they have a fairly high income that they're living off of, $250,000. But let's say that some of that is absorbed in business expenses and not a true $250,000 of income that they're taking out. But the full economic benefit is somewhere around there. You cannot plan for the need for coverage any farther than tomorrow. You always have to assume that tomorrow is the day that you're going to die, and that's how you plan for insurance coverage. If you can plan it 10 years or 20 years out, and you had a crystal ball, you could probably do it perfectly, but the assumption is that it's worst case tomorrow and you're providing for your family as of your current financial picture. So if he dies, the death benefit's paid to her, but because it's a relationship business, the business doesn't do well, and it's really just a cash asset that she has. So even if she were to reduce her spending by 30%, she would run out of money, given his current $2 million of death benefit. If she reduced it by 50%, it would get her out to maybe age 68. So the reality is that he needs to buy a policy that's in line with his business and personal needs, which happens to be, if you do the math, a $7 million policy, which gets her out to age 90, maybe a little further. We're running the investment growth assumption quite low at 2%. Now, maybe interest rates creep back up when we're at 3.5% here, but we don't want to assume that a spouse can live a long period of time off of a lump sum of assets, assuming that you're going to try to have a compounded 10% market return. That's unrealistic. So we keep them quite low. So that's a solution on this particular situation. I had a lot of slides. I didn't want to belabor some of the points too much. If anyone has any questions relating to the topics that we discussed, any specifics that might be specific to you or the individuals that you service, I'm happy to talk through any situations, talk them through, provide some free advice as it relates to planned or unplanned transition planning. Here's my information above, email, phone number if you'd like. You can go directly to our website, oswaldlife.com. We have some pieces out there. Admittedly, we don't update them on a daily basis, so some of them may seem a little trite. But feel free to take a look at our site. And I didn't really go into detail on Oswald Companies, but if you're unfamiliar with us, this year we are turning 125 years old. We are an ESOP, so we're employee-owned. We have somewhere around 400 employees currently in Ohio, Michigan, Columbus, Toledo, Akron, quite extensive there. We're part of a larger group, which is called Assurex Global. That organization can take care of larger clients in any state or country across the world. So they act as our continued business operations where we can't physically be. Besides the business consulting and insurance, we have personal risk management, retirement plan services that handle the 401k needs of employees, employee benefits. I don't want to belabor the point there. So, pretty broad brush that we can paint. So if anyone has any questions, I'm happy to answer them. I don't know how we unmute at this point, but
yeah. And Sam, we just wanted to thank you for helping us put on this webinar and allowing us this time, and and thank the overall OTA and everyone that's here. I don't know, Sam, if people were giving you any questions or anything, or if we're unmuted this time, but we baked in a couple minutes here if anyone had anything that they wanted to ask right now.
Yeah, no one has asked any questions. So
Okay.
I'm not sure what you guys want to do.
Well, no, I mean, we're all done. So, if anyone wants to reach out, offline, to Greg or to the OTA staff, and they can forward it on, that'd be great. But I know we threw kind of a lot at you, but we didn't want to, put too much into it. It's too much information as well.
I do have a question now.
Perfect.
Okay. I just sent it to you.
Is it in our app portion here, email, or how do we view that?
It should be in the chat.
Okay.
Do you want to just read the question?
Yeah, I don't see it here.
Sure. Yeah, it says, we have 3 key employees that we are working to transfer the company over in the next 3 years. It's a $4 million business that is growing 10% over year. Which life insurance should we think about?
Well, if you know that there's a finite period where you're going to be selling the business, I would, and you said it was over the next, how many years? 4 years?
3.
3 years.
3.
So
yeah.
The shortest duration insurance that you can get is 10-year term insurance. That would probably suffice for the needs. However, depending on how the owners are going to be bought out, they may have a permanent insurance need that would allow for the people who are buying them, buying out their ownership, to buy permanent insurance and provide cash value to use assets to then buy them out over a period of time as well, instead of a 4-year period. Some people prefer it that way because of the tax benefits of it. But on the surface, it sounds like a 10-year policy would probably suffice if they have a clear and definite way of buying them out, like simply getting assets from the bank and buying them out that way in the form of a loan. You can do what's called annual renewable term, which is really only less expensive for the first year and a half. Then it exceeds the cost of a 10-year term in most cases. So 10-year term is probably going to be your best bet.
Okay, and then he's asking who should pay for the insurance.
Well, whoever is going to be buying the owner out really should be the payer. The business can be the payer of the insurance, but you can never deduct the premium. Deducting the premium would create a taxable distribution of the death benefit proceeds. So if they were to have the company pay for the policy, the people who are going to be buying out the owner would basically pay the economic benefit, which means they'd be paying taxes on the premium cost. So they can have it clean and run it through payroll, but they would be obligated to pay the tax on the insurance premium. The real question is who should be the owner of that policy. So if the owner potentially has a trust and they have an estate tax issue, they may want to consider making sure that the trust is the owner of that policy.
Okay, that seems to be the end of the questions.
Great. We appreciate your time.
Very good. Thank you.
All right. Yes, thank you, everyone. And again, if you have any questions, you can reach out to the OTA or to us here at Oswald.